And the CEO actually said that they're soon going to begin deliveries for 2024. And NIO products, he says, are equipped with the highest computing power among production vehicles. So pretty interesting there. And the looking ahead to the first quarter is expecting revenue of between 1.48 billion and 1.56 billion.
Opportunity, potential, and analysis. We have seen NIO emerge as a significant player in the electric vehicle market, capturing attention with its premium smart EVs. Despite its potential, recent financial performance has posed challenges, with NIO grappling with losses amidst competitive pressures. In this video, we'll dive into NIO's current position and explore the possibilities for upside growth. Could NIO be on the brink of a turnaround?
Yeah, if you look at their data, they're like in the top 3 when it comes to total sales here. So when you're looking at the Chinese EV makers, they're not that profitable, to say the least. Even if you look at BYD, which really focuses on not only EVs, but also hybrids, their margins are very, very low. I mean, you're kind of looking at the same type of ICE type of margins where there could be between 4% to, let's say, 8.5%, 9%. So they have to churn out more vehicles or sell more vehicles in order to be profitable here. That's a little bit different than what we see from Tesla, which Tesla has probably the highest margins in the EV space here. So they don't have to sell as many cars in order to turn a profit. But once again, we see these price wars happening in China and even in the Eurozone, and that's putting pressures on margins across the board here.
If you remember NIO's recent earnings report, it was a bit of a mixed bag. While they managed to beat revenue expectations by $70 million, they missed the EPS estimate by 7 cents. This resulted in single-digit top-line growth for the fourth quarter, along with widening losses as anticipated. However, there are some positive developments to note. Despite the challenges, NIO has been making significant progress with its vehicle margin trend, which could be a major focus in fiscal year 2024. This is crucial as the company expands its production footprint. Although there's a risk of shares dropping below $5, they're considered undervalued based on revenues and hold long-term revaluation potential. The recent margin growth in Q4 2023 is particularly noteworthy, marking the 3rd consecutive quarter of improvement. This upward trend in vehicle margins, along with positive delivery momentum, suggests a potential path to profitability for NIO. Additionally, with plans to release updated models and enter the luxury sedan market, NIO is positioning itself strategically to appeal to a broader customer base. Looking at the projections for Q1 2024 deliveries, NIO expects modest year-over-year growth, with revenues also projected to show a slight increase. However, these figures fall below consensus expectations, indicating ongoing challenges in the EV market. Despite this, NIO remains the strong contender in the industry, with potential for growth and profitability in the long run. Now, did you hear about NIO's recent partnership with For7 Limited? Back in February, NIO made headlines by signing a technology license agreement with For7, a subsidiary of CYVN Holdings, an investment firm backed by the Abu Dhabi government. This move came after Abu Dhabi's hefty investment of $738.5 million into NIO the previous year, which significantly bolstered the company's financial standing and demonstrated confidence in its growth trajectory. For7 will leverage NIO's EV software for research and development, as well as the production of its electric vehicles. This agreement is significant because it validates NIO's cutting-edge EV technology and underscores the potential for collaboration among electric vehicle companies in sharing software and driving technology. It's a strategic move that could further strengthen NIO's position in the EV market and pave the way for future innovations.
Yeah, absolutely. We continue to see that have an effect. If we look at the report here, earnings per share did beat with a loss of 39 cents versus the 51-cent loss expected. That was up about 11% year over year. Revenue beat as well, 2.41 billion versus the 2.29 billion expected, up about 3% year over year. As we know, Q4 deliveries rose 25%, coming in at 50,045, but that's down about 9.7% quarter over quarter. Vehicle revenue up 4.6% year over year, but down over 11% quarter over quarter. If we look at gross margin, similar story, up about 7.5% from last year. Coming in at 7.5%, expanded about from 3.9% last year, but that's down from the previous quarter's 8%. If we look at the outlook side of things, it didn't get a lot better for deliveries. They're expecting 31 to 33,000 units.
Now, according to one analyst, NIO faces intense competition in a rapidly saturating market for battery electric vehicles. While global BEV sales are on the rise, there's a looming concern that this growth will eventually plateau. As more manufacturers enter the market and offer new models, consumers are becoming more discerning, leading to potential price wars. NIO's positioning in the luxury segment offers some insulation from this price pressure, but competitors like Bentley are also pushing for full electrification by 2030, posing a new challenge. Despite its unique position, NIO must contend with these established luxury brands, as well as other major players in the automotive industry. Financially, NIO has faced stagnation in growth and slow margin expansion in recent quarters. This raises doubts about its ability to meet forecasts and cover expenses through its own free cash flow. Until NIO demonstrates consistent performance and financial stability, it remains a speculative investment. But before we move on, we just want to thank you for watching this far. Meanwhile, a Seeking Alpha analyst believes that despite NIO's current profitability challenges, there are positive signs, particularly regarding its margin trend. The analyst highlights NIO's attractive valuation, noting that its shares are trading at a historically low price-to-sales ratio of 0.65 times. Comparing this to the one-year average price-to-sales ratio of 1.30 times, the analyst suggests that if NIO were to revalue to this average, its valuation could double to around $10.80. Looking further ahead, the analyst maintains a fair value estimate of $11 for NIO based on their previous analysis. However, they acknowledge that this estimate may change depending on the company's ability to deliver growth and narrow its operating losses. While there's a possibility of adjusting the fair value estimate downward if NIO's vehicle margins were to decline significantly, the analyst views this as unlikely given the current favorable margin trend and the company's expanding production capacity. But we're not done yet. A Motley Fool analyst said that based on NIO's latest earnings report, Morgan Stanley's Tim Sale reaffirmed his bullish stance on the company despite the earnings miss and lower delivery projections. Sale reiterated his overweight recommendation and maintained a $13 price target for NIO's shares. Despite the disappointing quarterly results and weaker guidance for the current quarter, Sale attributed the performance to specific factors like inventory provisions and depreciation on production facilities. Looking ahead, he acknowledges the challenges facing NIO, especially in a maturing EV market where competition is intensifying. With EVs becoming more commonplace, sales growth is slowing down, presenting a tougher road ahead for companies like NIO. He remains cautious about NIO's prospects as a top global player, suggesting investors should exercise caution despite Sale's optimism. Finally, DBS analyst Rachel Neo remains bullish on NIO stock, reiterating a buy rating with a predicted 45% upside next year. NIO anticipates that NIO's upcoming launches, such as ALPS in the latter half of 2024 and Firefly and NIO ET9 in 2025, will significantly boost production volumes and expand its market share. Additionally, NIO plans to establish 1,000 battery swap stations and 20,000 battery charging stations in 2024 to solidify its position as a leader in EV battery swapping. Despite reducing the vehicle sales growth estimate for 2024 due to industry challenges and heightened competition, analysts on TipRanks maintain a moderate buy rating for NIO stock, with 3 buy and 3 hold recommendations. All in all, the biggest risk for NIO is the potential reversal in the margin trend if EV companies continue competing primarily on price, driven mainly by Tesla's aggressive price cuts last year. Secondly, there's a near-term risk of NIO's stock price sliding into penny stock territory, which could undermine investor confidence and possibly lead to a reverse stock split. Additionally, weak initial sales for the ET9, declining sedan production shares, and slowing top-line growth could all disappoint investors. There's also the macro-specific risk of a potential invasion of Taiwan, which could further damage the reputation and investability of Chinese EV companies. NIO's recent earnings report showed expanding losses and a positive trend in vehicle margins, supporting the continued strong buy rating. Despite challenges, the stock remains undervalued based on revenues, likely due to overly bearish investor sentiment regarding the company's profitability. The probability of a recovery rally in the coming weeks appears high, considering the already discounted stock price and market expectations. Given these factors, the question for viewers is, will NIO's stock price rebound in the short to medium term? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know more about NIO's Q4 2023 earnings report, just click this video right here. Thank you for tuning in and stay tuned for more exciting content in the future.